Good morning, everybody, and welcome back to Money in the Law, My FM 101.3. I got my glasses here.
Yeah, you do. Nice, so you can see the radio.
And on Holliston Cable Access
So you can
TV
hear
or
yourself.
the Holliston Hub. I'm your host, John Drohan, with my co-host and dear friend, Jay Marsden. Jay is from the Marsden Law Group. I'm from Main Effort Financial, so we have some sort of credentials in order to be able to talk about.
We've been credentialed. I don't know if we have credentials, but we've been credentialed. Whatever that's
years
worth.
ago,
Yep.
years ago, right? Yeah, and there's some whatever. There's some stuff you got to do to
There's
keep
some
your
initials
credentials.
after our names, and
Exactly.
it's not just the JR and Junior.
That's right, because we're both juniors.
That's right. Another thing.
That's
Yep.
right. Another
That's right.
thing we have in common. So this is just to remind everybody, just to review. This is Money and the Law, where we talk about things that have to do with money and finance and investing and all that other fun stuff, and then we talk about law and how that connects to money, and also how just like in general, like the kind of the things,
intricacies of the legal and the financial world that we live in.
Well said. As my partner is as so eloquently put. Well said once again. So speaking of which, how are you doing, partner?
Well, I mean, I'm doing good. I'm doing okay. I mean, I'm recovering from the big snowstorm.
Yeah.
I mean, back's a little sore. I had to roll through all that shoveling that we got.
Remember,
from the
this
big nor'easter.
airs on Saturday, so no one's going to care.
Well, they're
by
still
then.
recovering as well. I mean, they're probably, hot compress, hot tub, thermo gun. I mean, come on.
I'm not talking about the weather.
Look, there are some towns that get 30 inches of snow.
Yeah.
Right. So this is like the weirdest, wackiest.
Oh yeah.
Yeah. Some people get hammered. Right?
But I mean, and that's the thing is this winter has been ridiculous.
Yeah.
It's been like the anti-winter. Yeah.
Let's not get too carried away. Let's
not
jinx ourselves.
And
for those of you, by the way, who listen to the show today, I hope you had a great St. Patty's Day.
St. Patrick's Day was last night.
I hope you celebrated effectively.
So our show airs at 11 a.m. So this is right about the time. Right about the time when you're starting to
we're in second Bloody Mary territory right now. You only get another hour. No, you can't have any afternoon time. You got to switch over at that point.
Unless your St. Patty's Day was not unlike the first or second Hangover from the movie, where you're waking up face down with some kind of
roof of a casino somewhere. That's right. That's
on the roof of a casino or in some hotel in Bangkok, right?
We've joked about this in the show before, but I think my daughter wanted to put that. She put it on the other night. It was on Netflix, whatever it was. And that's a movie that you see on TV a million times, broken up by 90 commercials.
Yeah, because and if it's on TV, then it's the dubbed down
version.
Yeah.
We were sitting there, and of course it's like it's one of those you just can't turn it off, right? So I'm watching it, and I'm thinking to myself, I keep waiting for the commercial to kick in. It doesn't kick in, and it just keeps rolling, and the momentum is building. Man, that is the original one. That is one.
The first, we just reviewed it the other night.
Movie.
We just reviewed again with my daughter, Tom. Speaking of which, Tom's here too. Let's not forget about Tom. Yeah. Tom from Holliston Cable Access TV. Tom, have you seen the movie The Hangover? Of course he has.
Of course he has. Why not?
Of course he has.
He's
been there in Vegas. Tom, a big Mike Tyson fan. So the first time you see that movie and Tyson shows up, you're like, you don't see that coming, right? And you're like,
no,
Mike Tyson.
Yes.
No,
and not only, and he's great.
He's great. He punches Zach Galifianakis. Yeah,
takes a punch champ, referred to as champ. And then back at the house, and he says to him, making fun of that's such a regal, genteel, beautiful animal.
Yeah.
Bradley Cooper, and then he's messing around with the tiger.
And then he shows up.
And then he says, "Where'd you get the cop car?" And he goes, "Oh, we stole it." And then Tyson loves it. He loves it.
That's pretty cool.
He's like, "That's great." Yes. So the whole thing was great.
And that was like the kind of the outbreak of Zach Galifianakis.
Oh.
Yeah, that's when you're like, who is that guy?
Man,
right?
How, and the scenes where he's trying to be Bradley Cooper, he's mimicking Bradley Cooper, and does my hair look like his? And they're banging on the windshield together at the end. And there's so many great characters and great actors in that movie. So it was pretty funny, and it's one of those things. Like I said, you see it on TV, you're like, oh, this again, and you roll through it, start to finish,
just keep going,
and you're like, oh man.
And it's funny, and and the second one isn't quite as good as the first one, because the second one is the first. It's just they just like, oh, let's just continue the jokes. Let's just try and keep doing this. Yeah.
The scene at the end where he hands off the bride, and the old man, he's all red, and he says to the old man, "I'm sorry about everything." He just looks at him and he goes, Vegas. He winks at him. He just kind of walks away. It's so funny. All those scenes, great scenes, great scenes. That's not what we're talking about today.
No,
though.
that's not what we're because no one's going to Vegas.
Nope,
no
nope,
one's
nope,
going to Vegas.
nope.
And Vegas does seem glam. You've been to Vegas,
Never.
right? Yeah.
I have no interest.
So
I have no
neither have
interest.
I.
Yeah, I
right?
have no interest.
So Vegas does seem glamorous. And we've been to the casinos. We've talked about the casino before. You know, we've been to like the local ones, right?
Oh yeah, yeah.
And I get it, right? I get the whole like Vegas, you know, it's so exciting. It doesn't sleep. There's so much to do there. As I'm watching the movie The Hangover, and again, I'm watching it and I'm drinking water.
Yeah.
I'm like feeling sick to my stomach. I'm like feeling like I'm getting a hangover. I'm like, nobody needs to drink that much, right?
Yeah. Well,
I mean,
it's like carried away.
yeah, like, no one needs to drink that much that late at night.
That's right. How about that? How about that?
Yeah, we'll shut it short.
I'm a second shift guy these days.
Yeah,
Moving back.
Oh, right.
No more third shift for me.
I don't. No. I don't know. The final. You mentioned the other day you were talking about the final. I love the whole for those of you out there who don't know, Tom, do you know what the final is? Are you aware of that term? And I was actually kind of surprised that you were aware of that term. I mean, why would I?
You've never heard me shout that out?
Why would I be surprised? But the whole term of final is like so everybody's wrapping things up and it's like, all right, it's time to go. But then there'll always be somebody who'll be like, wait, we have to have the final.
Final?
Yeah, which is the drink that nobody needs,
yeah.
right? It's the beer, it's the cocktail, it's the shot of whiskey. Yeah. It's no one needs it, but we're going to do it just because. Yeah, and
we've actually tweaked it a little bit because sometimes what will happen is final will become another final, and then you worry about it. So we had to put a hard stop on it. So final finale. That's it. Then it's all like that's it. You can't that's it.
You can't.
So nobody can jump in.
Unring the finale.
That's right. That's right. It's like Uno. You can't throw another card down. You're done. Yeah. That's it. It's over.
It's like the lights came on and
that's right.
There's
you don't have to go home. You can't
the bar's
stay here.
closed.
That's right.
You can't
that's right.
stay here.
That's right. Yep. They put the covers on the taps. All that stuff.
Coach Todd Kiley for our softball team. The softball season's about to come up. He's the final guy.
Yep.
And it's funny because speaking of the coach, right? I'm a big fan of the coach. You know. How many Super Bowls have they won? I don't know, 11 or something. Anyway, Coach plays on my softball team, and it's funny when he first came and he's a very good athlete. And when he first came on the team, he was the only guy I know because most of the time when guys come on the team, the wives are a little bit like they don't get it, right? And they're like, well, what do you mean every Sunday? Blah blah blah, right?
Yeah.
Todd Kiley's wife, Sarah, God bless her, was the opposite. She's like, could you please take him on Sunday? And I don't care what time you bring him home, just make sure he gets home safe. No other wives they're like, you better be home right at 9:30.
Just take him. Just take him. It's all yours.
So Kiley is the final initiator.
There you go.
Yeah, and it's funny because he'll do final like when guys are walking to the car. Like, hey, final, I'm like, no.
Engine running.
No, it's chasing after you, right?
Yeah. Wait a minute.
I got something in this.
Yep. So I believe you wanted to talk banking today.
I did.
Not like ATM. Like how was your, did you enjoy your time at the bank, and how did Mary or Tom take really good care of you? And this is
no. I wanted to talk about kind of the general concepts of the bank because as everybody knows, there's been some banking
related
drama,
news, related news,
some banking related drama, and we can also we'll also like go back to some 2008 banking related drama that happened as well.
Yes.
But just kind of the idea. Because people, I feel like a lot of people don't really understand banks, right? They don't understand kind of how, like, what is it, like, what's the difference between, they know the Bank of America, like you said, I know I have a checking account, I know I have a bank, I know my money automatically gets deposited there, and, kind of just the whole, like, a little review. Again, for a lot of people, it's not going to be that, this earth-shattering, but just the review of kind of how banks make money, and then how banks are going to, why would a bank like Bear Stearns, or why would a bank like the Silicon Valley Bank, why would a bank fail? Like, how does that happen? So we'll talk a little bit about that. And it's, it's exciting, it's thrilling, and we'll throw in some.
It's a St. Patrick's Day dream team right here. St. Patty's Day and banks.
So so speaking of St. Patrick's Day, so we had kind of alluded to the last show that we were gonna. This could be potentially the same. I brought water. I see you
I
brought
brought water
I
as
brought you
well.
water
Yeah.
in a Pepsi bottle.
That's right.
It's
I
even
walked out
better.
of the house and I'm like, I don't think I have any water in the house. I'm like, we're all out of water. Okay,
Yeah.
so
So-
I might have some at the show.
She went, yeah. So
Going
there's
high end over
so
here.
there's no and Tom was I felt like Tom might have been a little peer pressure last time because Tom's he's not a big drinker. He says, well, every now and again I will. So I don't know if you were excited about having some last
whiskey at
some
9:30 in the
Tullamore dew.
morning?
We'll
Yeah,
have to do.
yeah.
We'll have to set up another time. Maybe at Jay's office. I think he might have he might have a little left up
I
there.
have a little left.
Yeah.
Well, hurry. Hurry,
Yeah,
yep.
Mr. Bob Whiting is up there.
That's right. That's right.
All right, so we'll take a quick break. We'll come right back, talk about banks, and talk
So
about
exciting.
water on St. Patrick's Day.
And we're back. My FM 101.3. Jay Marston with the Marston Law Group. John Drohan, Mania for Financial. Tom, we're sitting here knocking back a little H2O, getting ready, gearing up. What would you say the word? We're
Pre-game?
not pre-gaming. No, we're
Prenuptial?
not prenuptial. No, we're preparing. How about that? We're just preparing.
Preparing?
For big St. Patty's Day coming up, and so we're behaving ourselves.
Well,
We're
St.
behaving
Patty's
ourselves.
Day was from the filming. St. Patrick's Day was yesterday. So
Yes,
what do
it
you
was.
have? What do you have going? I mean, you have some plans, right?
Oh,
You might be
I'm
you're out of town.
I'm
right?
out of town. I'm
Yeah.
out of town. We have long threatened to go down to the great city of Key West for St. Patty's Day, and so this year we decided,
And this is
why
it.
not?
This is
Why
it.
not? Why not? Why not? I mean, to the point that like if we were hanging around on, let's say St. Patty's Day is on a Saturday, for example, if we're hanging around, we're dialing in down there because they get a bunch of webcams and people are on stage and you can kind of follow all the
Yeah.
shenanigans.
So and have you been there on St.
Nope,
Patrick's Day
this is the
before?
first time.
Oh,
First
so
time.
this is going to
So-
and the whole crew's going.
The whole crew's going, and there appears to be some activity going on down there. They seem a little organized.
Really?
around
That's
this town.
interesting. That's,
Yeah.
I mean,
I wouldn't have expected that.
post-COVID.
Thought maybe
you
it kind of
think-
snuck up on them, but
Yeah.
no, they seem to have.
What day? Holy crap! It's
oh my
March.
gosh, oh my God, we gotta throw some green stuff up. So we might spend some time in the great Irish Kevin's down there, and raise a pint or two.
Raise
maybe.
a pint or two. It sounds like it's going to be absolutely fantastic.
Hey, I'll let you know when I come back and can't remember any of it. I'll tell you what a great time I didn't have.
I don't know what I did last night for St. Patrick's Day. No, really, I don't know. So that's good because we don't have anything planned, but
Looking forward
something.
to it.
Yeah,
Yep,
hopefully
looking
it's
forward
not
to it.
one
I'll
of those-
report back next week.
All right, so let's talk banks. All right, so recently the Silicon Valley Bank has kind of gone underwater and is currently in the process of some sort of rescue or bailout that seems to be
Yeah.
happening. And this throws us back to the 2008 collapse of some of those no-name banks that we never heard of, like Bear Stearns, right? And
Lehman
Lehman Brothers,
some
yeah.
of those, small mom and pop operations.
Right. And so again, what happens? Just like any bank's a business, right? That's
Yes,
all it
it
is.
is.
A bank
Yes.
is a business, and they are in the business of the way they make money is they loan it, right?
Yep.
That's how banks make money. So banks hold money, they take in money, and then they loan it. And the whole idea of if I as a bank, I need to be able to kind of cover my expenses, right? And the same thing as if I have a business, I need to be able to cover my expenses. My income has to outweigh my outcome.
It's an
right?
arbitrage.
Yep.
Yeah, it's an arbitrage. What are the rates? You see a bank paying this much money, and they say, well, they'll pay you this much money, and then they're doing something with it to make more than that.
Exactly.
That's what they're doing.
Exactly. So the reason, the reason that this has kind of gone on with the Silicon Valley Bank is what's happened is the interest rates are going up, right? So
Yep.
so as the interest rates go up, the Silicon Valley Bank, let's say, and I'll make up a number. Let's say a 60% or 65% of their revenue comes from long-term mortgages or long-term loans,
Sure,
right?
long-term debt, yep.
So let's say that those loans were written, 2, 3, 4, 5, 10 years ago.
When rates were really low.
Right. So these are loans that are written on rates that are in the 2s, the 3s, and the 4s, where now the short-term money, the money that when someone says, oh, I'm going to give you money, what are you going to give me in return? What are you going to pay me for short-term debt? Or if I need to borrow money for the short term, then it's going to cost me more money to borrow money than I'm going to make on my long-term loans. And what happened is now they're, just like anything, they're upside down, they're underwater, and because the rates have gone up, because now in order to borrow money or in order to hold money and to have money to be able to pay an interest rate, they have to pay more than what they're coming in. It's coming in for the long-term debt.
Yeah, so the numbers kind of reverse on them, right?
Yep.
So where they were making money hand over fist before, now all of a sudden, hold on, our cost of goods sold, our operational costs have gone through the roof to a certain extent. Now they got to come up with more dough, and if they don't have the deposits to support that, then they run into a problem.
And that's the thing is the there's the banking, and part of banking is, as we say, it's kind of simple, but on the other hand, it's very complicated in the sense that the way banks can, just like the arbitrage of the way they borrow money, like banks will borrow money like day to day, right?
Sure.
And they'll do this in order to be able to kind of pay their, to be able to pay their obligations, and these day to day, the value of, or the interest rate that they can borrow from day to day, and this is what happened in 2008 as well, is the banks, they were making money hand over fist because they'd be able to borrow money at, let's say a rate of like 5%. We'll kind of make this number up.
Yeah.
So if I can borrow money today at 5%, but then I can go ahead and I can make 6 or 7% on it, like in a very short period of time, it's almost like it's like free money. It's like found free money.
And it doesn't like just that calculation right there. It doesn't sound like a lot, but when you start putting lots of dollars behind this, then these things start to really be revenue generators.
Yeah, it would be the equivalent right now if I told Jay, if I said, Jay, I'm going to give you $10, and then when I give Jay $10, Tom is going to then turn around and give me $15.
Yeah.
And this happens every day where I'm like, well, why wouldn't I do that? Oh, here you go, Jay, here's 10, and Tom's giving me 15.
Yeah.
And it's all based on kind of these interest rates that are so, they're unstable in that, it's always going to be like this. We're going to build our business model on this, so we're going to be able to buy buildings and buy land and hire people and open branches.
Yeah, rates are staying low forever.
Just based on this, on the fact that if I give you 10, you give me 15, and then all of a sudden, when the rates change and the banks aren't aware of that, or they're not built for it, or they don't have the capital to back that, now it's like, well, wait a minute, Jay's like, no, you're not giving me 10 because I'm going to get 10. I can get 10. Right. I can get 15 from these guys. So you have to better yet, you have to give me 20.
Yeah.
And Tom's like, I'm still giving you 15. And you're like, well, wait a minute.
Right.
How is
math doesn't work anymore?
Why can't you give me more, Tom? Well, because this is how much it costs.
Right.
So this is where the Silicon Valley. So but what happens is, people don't see this, like the normal people and the business, and this is the same thing that happened in 2008.
Well, you bring up a great point. If you're using your bank in the very traditional way that a lot of people use their bank, you don't see this. You're 100% right.
People don't know, right? You don't, even with your mortgage, right? You don't know. You're just like, I know I pay my mortgage every month, and that's
right. But I think that's where we've always talked about the importance of having people, right? The importance of having insurance people that you can talk to, investment advisors, lawyers, people that can answer questions for you. And in a lot of respects, banking works the same way, right? You in the grand scheme of things, you may not ever go to your bank for a loan, right? For a lot of people, they get their mortgage, maybe they get a second mortgage because they buy a place or they take some money out of their house, they renovate their kitchen or something like that. But a lot of people don't do more than that, right? Yeah. But then there's a whole nother segment of the population that uses a banking relationship to fund all kinds of activities, all kinds of business.
Well, I was going to say commercial stuff, like
yes.
Especially in the business world, both small and large. That the banks are the cornerstone. They are the center of all that activity.
That's right.
Because business, just so for everybody knows, business doesn't happen unless somebody can borrow money. Right?
Well, you beat me to it. Everything is not a cash transaction.
Nope.
Right? I mean, it sounds
rarely is anything.
It sounds a little crazy,
transaction.
right? But everything is not a cash transaction. So when these people are putting deals together to buy a piece of property, to buy a hotel, for example, to build a
casino right in your backyard.
Right, a casino. These guys have to go and get the financing, right?
Yeah.
It's a huge part of the project. Most people are not going to plunk down $500 million of their own money and say, I'm doing this.
Nobody would, but you wouldn't do that. Nobody would do that anyway because they don't have to.
Right.
Because I don't have to, because I have $500 million and I'm going to use that $500 million for other things, or for because or to do. But if I can finance it, and again, so in the people always talk about, oh, big banks and banks this and they get kind of down on the bank. None of this happens.
Banks built this country.
None of this happens.
Banks built this country.
Exactly. Like, you don't buy a car, but rarely do people buy a $50,000 car in cash.
Right.
That's right. Rarely. No one buys your house in cash. No one. I mean, unless you're just like one of those, real estate, where even those guys. But how many people do you know buy their house cash?
But even those guys, they'll do the calculation in their head and they'll say, does it make sense for me to pay cash for this house? Or to finance it.
Yeah.
And if they finance it, what's the first question they ask themselves? Yeah. Well, what's my rate going to be?
How much am I borrowing? How much does it cost for me to finance?
What are my borrowing costs to do this transaction? Because I have to factor that into my cash flow conversation to see if this deal even makes me money. Because for the most part, no one's a charity.
Yeah.
You're in business to make money. There's a project, and you see it, by the way, when you're driving around town and there's a project going up. And what does it say on the side of the fence?
Picture of a bank, yeah.
Right? Either a picture of a bank that says, this project, this neighborhood improvement brought to you by Cambridge Savings Bank, Needham Bank, whatever it is, right? Because they're making an investment in that business, in that building, and then that business is going to generate, jobs, and then off we go, right? Then it's a big multiplier effect. But to your point, it's not just money in, money out. It's not about that,
nope.
Right? There's so much more going on behind the scenes with a lot of these bank balance sheets of what they're doing with the money that depositors give them. And by the way, hope when they go to get it that it's still there. That's the idea.
So that's the happy, American dream kind of view of the banks, right?
Correct.
And that's where, like, okay, well, and there's a lot of regulations that go along with, like, making sure these guys stay in there.
Yeah.
Well, this again, you thought there were, right?
Yeah, that's right.
There was, and it's funny. It seems like the smaller banks, because once this Silicon Valley Bank, all this happened. We saw in the market, we saw some real significant market activity, particularly for the smaller banks. Now, the giant banks like the J.P. Morgans, the Goldman Sachs, the Bank of America, those guys, their stock dropped, but 1%, 2%.
Yeah, not a big deal.
But then when you see some of these other, like these smaller kind of regional banks, then everybody's like, well, wait a minute, if this can happen, it's because they liken them as relative, like the same business model.
Credit Suisse's stock price dropped almost 30%.
Well, Credit Suisse is a different animal. So we're recording this on Wednesday. So Credit Suisse went down 30%, coming at the opening bell today.
Because what happens is when one of these banks have problems, everybody, just like in 2008, everybody says, if these guys are having a problem, right? If Silicon Valley's having a problem, what are these other guys?
How are they different from?
What are other guys have on their balance sheets that we don't know about?
Yeah.
What's going on? And and then everybody gets a look under the hood, right? And some banks will be fine, and they'll say, well, we didn't play in that space. Other banks, well, we followed a little bit of this, we did a little bit of accounting here, and then, and it doesn't look as great as we'd like it to, and everybody gets nervous.
But
right?
And the problem is what happens is you have is in the banking industry, just like or in any industry, if you have the ability to make more money, right?
Sure.
If you have the ability to make more, like crazy more money, for instance, like if you have, let's say that you own a retail store, right? And all of a sudden there's a product that that you can get more that no one else can get, and you can say, look, no one can get Beanie Babies anymore, right?
Sure.
But now everybody wants one, right? So instead of $10 a Beanie Baby, I can charge $100 a Beanie Baby, right? I can charge so much more money for this, right?
Yeah.
Right? And the same thing happens with these banks is they get in a position where wait a minute, if I don't borrow money like on a 30-day note, if I borrow it on a 1-day note versus a 30-day note, right? The 1-day note is so much more lucrative. I can make so much more money.
Well,
right?
And then what they'll do, and you would make the same calculation in your business, is they say, well, why don't I borrow more money to make more money? I mean, if I only have enough money in my pocket to buy 100 Beanie Babies, I can only make X amount of dollars.
Yeah.
But if I can buy 1,000 Beanie Babies, and if I can borrow the money and I crunch the numbers, even after my borrowing costs, I'm still making a ton more money. The banks go through the same exact calculation. I can loan money, I can make money, maybe I'll borrow more money to loan money at this rate or to finance this deal, and what's that going to look like? And by the way, the people who are borrowing money, they're having the same conversation. There's people who are saying, look, you know what? I need to borrow money for this deal, and I need it right quick.
Yeah.
And the bank says, well, you know what? You need it right quick. We don't like the loan particulars per se, but you know what? We'll give it to you, but we'll give it to you at 8% instead of 6%.
Yeah, for us, it's a little. We're assuming a little more risk, so you're going to cost you, right?
That's right. That's right.
And so so back to like in that analogy of where, and again, it comes down to like the analogy of what's the tipping point between being speculative or being a smart and assuming calculated risk, because all businesses need to take risk. Like, so in your case, so if you have a law practice, you say, okay, I think if I hire another paralegal, I'm going to increase my costs. But that is going to allow me to do this much more work, and that is going to allow me to, again, it's going to increase my bottom line. If you said to yourself, I'm going to hire 8 paralegals, and I'm going to borrow the money to do that, right? I'm going to borrow money to do that, and then if I do that, then I could, instead of having a $2 million a year law practice, I can have a $20 million a year law practice.
Yep.
But guess what? If I do that and it, for whatever reason, it doesn't work, or if I buy 1 million Beanie Babies and then all of a sudden Target starts selling Beanie Babies, I'm like, now here I am. Now this, and it's all because I kind of went past that point of smart business and trying to make money, and I went into becoming greedy. And this is what happens. And this is kind of what's happened in the banking in some of these banks right now, and that's what happened with Bear Stearns. That's what happened with Lehman Brothers back in the, when they were buying these mortgage-backed securities. They were building their practice. Their book, their whole balance sheet was the majority of their balance sheet was built on these types of loans. And all of a sudden, when the bottom fell out, here you are. They're like, we don't have.
Well, the entire house of cards was built on the idea that everybody was just going to keep refinancing, and then the property values were going to continue to be upcharged, if you will, in the house that, we talked about this on the show a couple times.
And people were going to keep paying their loans.
And people were going to keep paying their loans, and then all that house of cards starts falling apart because they overextended themselves and they started loaning money to people who had absolutely no ability to pay back that loan. And it was always, you remember back then, it was like, oh, don't worry, I know your rate is 8.8. We're just going to refinance. We're just going to refinance. You're just going to refinance. We're going to do a principal interest, payment of this. We're going to do, they wanted to have mortgage insurance. You can have 2 separate loans. One loan is going to be for your principal. The other one is going to be for this extra money. We're going to do an 80-20. These guys can craft, and if you talk to them, they'll tell you about there's all kinds of programs out there, and this is what these companies do. They package programs, right? They're not just making this up. They're putting something together so that you can figure out if you want to borrow that money, it's out there. You know, there's all kinds of loans that you can take.
And that's the thing. So if you're in the banking industry, and you say, okay, well, if I'm gonna give these risky loans and I can charge a higher interest rate for it, right? It's the same thing. It's like if I can do that, then this is going to increase my bottom line by X amount, right?
Yeah.
And I have the capability to make that much more money. However, and this is the same thing that we do and that Jay and I will do in like financial planning. Like, whenever you're setting up the plan, okay, worst case scenario, right? So here's how we're going to invest your money. This is how we're going to break down your portfolio. Worst case scenario, you lose your job, you need money, you need $50,000 or whatever. There's always kind of like this worst case scenario piece, or like that contingency that we don't think it's going to happen.
Right.
The likelihood of it happening is probably not going to happen. But if it does, it won't be pretty, but you're not going to have to go, if you're retired, you're not going to have to go back to work.
Right.
You're not going to it's not going to have to change your goal. And that's what we've always talked about, the difference between taking a risk and taking a gamble. Risk is something that you can recover from, where a gamble is something that significantly changes your path. And
there's going to be a conversation that says, hey, this part of my portfolio is not doing well. Why is that? Well, you have a sleeve in your portfolio exposed to financial services or to the financial services sector, and that's also filled with regional banks or whatever the flavor of that part of your portfolio is, and that ripple effect of what's going on may have some impact. It's not the end of the world if you diversify it. That's the whole idea. But you'll see it. You'll see it, and that's directly where it'll come from.
All right. let's take a quick break. I do want to come back and talk about the regional bank, because that's kind of been the scare now. Is like the regional banks, and we'll talk about some of the of our experience and kind of the local regional banks, and not can't speak on their behalf, but we'll talk about kind of what the good regional bank is, what position they're going to be in versus somebody who may be in a little bit of trouble.
All right.
Don't go anywhere. We'll be right back.
And we're back. My FM.
I'm always chugging water.
Jay Marsden with Marsden Law Group. John Droham, FF. That's why I'm doing it. This is my intro. You don't need to worry about it. You can just
nothing changes.
Just hydrate. You just
nothing
hydrate.
changes.
Just focus on your hydration. Focus on hydration. Talking regional banks. I was out with a couple of fellows last night, and one of the folks I was out with says to me, "Show you a picture that you probably didn't think you'd see in 2023." It was a line outside of a bank.
Yeah.
In Wellsville.
Yeah, a run on the bank.
It was a line. Yep. Now, this was a little different because most people getting in line at the bank were getting out of like a $68,000 SUV or all souped up Tesla, maybe some Maseratis in the parking lot. So it's a little different.
Yeah.
It didn't have 1920s complete vibes. But it was something that you weren't
at the Bailey Building and Loan, like
that's right. That's right. That's right.
We'll get you paid back in 60 days. That's the agreement you signed. How much do you need? Right?
Yeah, there wasn't a lot of that, but it was
Uncle Billy didn't have a string tied to his finger.
No, but it was something for the watching public. It was it was interesting, and this when we talk about a bank run, what that basically means is everybody shows up at the same time and want to get their money.
Yeah.
And the bank says, we usually don't keep that much money on hand to give everybody their money.
Your money's not here. Your money's in Jay's house.
That's right. That's right. We have a certain amount of money we kind of leave laying around.
And we have to, right? There's a rule.
Holding cash that we have to have on site, but we usually don't keep it all here.
Yeah.
A lot of it doesn't stay here. There's those big armored trucks that show up a couple times during the week to kind of get it out of here. So we don't have it all.
We don't keep it here.
No, we'll get it to you. And by the way, and it's not the same money you dropped off, right? You're a kid. You bring
you
your
write
money
your
up
name
to the
on
bank.
your money.
Yeah. You bring your money up to the bank. You think they're just going to put it up back, and then when you come back, it's the same dollars, right?
Safe deposit box.
Keep your paper route money back. Yeah. It's not that. It's not that at all. It's funny when I was at that small mutual fund company in town. I used to tell my clients all the time. I said, look, you got to keep a bank. Like you need a banking relationship, right? Don't run everything through your brokerage account, which some of the places will do. Some places will let you have a debit card on your brokerage account and your checkbook, and they want you to run everything through the brokerage account. And I'm not a fan of that. As much as I love brokerage accounts, I'm not a fan of that. I'm more a fan of saying, look, you can have a bank account, you can have a banking relationship.
Well, for all the right reasons.
For a whole host of reasons. At some point, you're going to need to borrow money, right? And you don't want it to be a margin loan. At some point, you're going to borrow money from the bank, and you're going to need to do something. So it helps you to have that relationship.
Right, and you also, and again, when you're talking about like your risk mitigation, right? So that the federal government insures $250,000 of your cash. So if you're going to hold on to cash, we tell our clients, put it in the bank.
Yeah, that's right.
There's no reason to hold on cash in a non-guaranteed by the U.S. federal government money market, or let's put it in that and look. And now, will the money market go belly up, and will you lose money? Odds are probably not.
Yeah, odds are not. Odds are not in that favor, but sure.
Yeah. Right, and the whole concept of money markets versus savings accounts back in the day was when money markets used to pay about twice as much as savings.
They paid some real differences.
This was back in the day. Like, hey, well, I'll take a little risk.
I get 5% of my cash reserves account. I'm getting 2 or 1 maybe at my bank account. Why wouldn't I?
So that's one big reason is I can off some of the risk onto the bank, right?
I mean, we tell people, look, you want to leave an amount of money in your bank that you think you're going to need, right? Unless you're a gangster, you're not going to need $100,000 in cash on a Sunday.
Folding
right?
cash, yeah.
Yeah. You want to go in, you want to write a check, you want to pull some money out.
They're out there.
You want to move some money from your checking account over to your savings account to cover your bar tab or whatever the heck you're doing.
Some guys like to have a little money to count, though, right? There's the counters. Yeah.
That's fine. I mean, that's fine too. I mean, you put that in the safe or whatever. But at the bank, like my point is, you don't need to leave $300,000 in your bank account, right? Like let's get that out of the bank. Let's get that working for you somehow, some way, some shape or form. Let's do something with that, but let's not get too caught up in that. Let's put it where it belongs.
Right. So the whole idea of you were talking about having this banking relationship.
Sure.
So the idea of I can keep cash there. I can keep the cash that I need, that I know. And we always talk about if from an investment standpoint, the fun part about having cash is that it gives me standoff for my investments.
Yes.
So if my investments everything's got a purpose, right? So if the cash is there part of that purpose is, so if I need money for whatever reason, short term, medium term, long term, I can get the money from the cash, and I don't have to go into my investments maybe at a non-opportune time. Maybe if the market isn't, in my favor at that particular time, then I don't have to go into or if my investment accounts are doing something else. They're generating income. They're generating income for me. Then I don't have to kind of mess with that in case I need money. So then you brought up the point about having the banking relationship for potential loans, right? For loan, and kind of in the in my kind of experience, right? So in our experience, so we're like the same age, and so we kind of grew up in that. When you buy your house, when you buy your first house, your condo, that, oftentimes there's mortgage brokers out there, right? There's people that sell, that's their job. It's not like and a lot of times these mortgage brokers were able to get mortgages at a slightly lower rate than potentially if you walked into a bank,
sure.
Right?
Yeah.
So if you walked into let's say the Middlesex Savings Bank or Cambridge Savings Bank.
Citizens, anything.
And you said, okay, I want to get a 30-year loan to buy a house. They're like, great, we have a loan department, and let's say the loan's going to be 4%. This is back in the day, right? And say the loan's going to be 4%. But if I went to a mortgage broker and said, no, we can do the same loan for 3.5%, and then arbitraging that the closing costs would be about the same. The more that you would go with the
over time you're going to save money by going with the broker
because you're getting a lower rate,
yeah,
and your cost will be it'll be lower. And what happens is these mortgage brokers, they were nothing more than they were just salespeople to sell these mortgages, and then the mortgages then turn around and be bought by a bank, right? So as soon as the mortgage,
they tell you ready at closing. By the way, you'll probably only make 1 or 2 payments to this loan servicing operation. We're probably going to sell this mortgage.
Yeah, and again, banks for all the right reasons. Hey, we'll buy that mortgage, and we'll house that mortgage. We'll get that interest rate. That's how we make money, for the interest that we charge on a 30-year loan. And for us, everybody wins. So now you have a slightly lower rate, and so this is kind of what happens like with kind of like that home purchase where you can get a slightly lower rate for mortgage.
Well, and here's where these guys are good, because if you're, again, we talked before about, not everything is a mortgage, right? Like not everything is a 30-year fixed rate.
I'm getting. No, you're good. You go. No.
You get there on your own.
I just wanted you to make sure that we're on our,
of course.
we're on the same page.
No, but when you talk to these guys and they're going to say, look, you're going to come in, you're looking for a business loan, right?
Yep.
And that might be something you say, look, I just need this for 5 years. I just need a loan for 5 years. This is what I'm trying to do, and I need some funding to do what I'm trying to do, and I think this is how this is going to work.
Sure.
And sometimes the bank would say, we're not in that space.
Yep.
Like, maybe somebody in our commercial department can help you out, maybe, but we're just not wired for that. We're in the 30-year fixed rate, basic blocking and tackling home loan.
Yeah.
That's us. Okay, great. You may have to go find a mortgage broker to put this deal together. That's what's going to happen.
Yeah, or the flip side of that is, you may walk into your local bank and say, we've had our checking account here for 20 years. We've saved enough money. We want to buy a vacation home. We'd really like to finance our vacation home with you guys in the 30-year loan. They're like, okay, yeah, here's the rate we can do, but not for nothing. If you go to one of these mortgage outfits, you may be able to get a lower rate. I don't know what the closing, but you may be able to find a better deal. So that may, like you said, they may not be as competitive in that space. However, let's say you said, you know what, we really want to refinish our basement, and we need an equity line of credit. There's no mortgage brokers out there that are giving equity lines of credit.
That's right.
So this is where, then you go to your bank, or like you said, if I'm a business owner and I want to take a commercial loan, I get that from a local bank or from a bank. And a lot of these, at least it's been in my experience, particularly around here, is these, a lot of these deals, the best that relationship is in with these kind of local regional banks that you have.
Yeah.
And so
well, because in many cases you're talking to the deal maker. You're talking to the people who are making the decision. Can you do this? Can you afford to do this? They'll game plan this out with you and say, well, let's see. Tell us what you're doing here.
Yeah, so in kind of a roundabout way, what I'm getting at is that, you know, in the wake of this whole Silicon Valley Bank kind of fallout, all of a sudden, like everybody's like, oh, you know, like Jay had mentioned earlier, like everybody's looking under the hoods of all these regional banks and like, hey, are you guys okay? Are you guys okay? And I'm sure, and again, I'm kind of like without any knowledge, I'm guessing, but I'm sure that many of them are. Many of them
Right.
are good, are fine. So, you know, of course, you want to do your due diligence. Do your due. There's one too many do's in there, right? Yeah. Do your due. Not bad, right? Do. Heartbreaker. One of my favorite Rolling Stones songs, right? When are we going to jam? As soon as I can learn it. A minor. A minor. Yeah.
That's right. No, of course.
Yeah. So, no, of course, right. No, I make them up. I don't go to F.
Play
I go
through
to.
it. Play
I
through
go,
the A.
yeah.
Play through the
Stay
A.
on D. This is a little guitar talk. So for Tom's like, I don't get it.
He
yet.
gets it. He gets it. He
So,
plays.
So the whole idea is that, you know, these regional banks for all of these, you know, for all of kind of like the business that, you know, that we kind of do in our space, and you know that those regional banks are the guys, they're like the bread and butter. They're the backbone of a lot of what happens, particularly in like these small communities.
Sure, yeah.
For small businesses, for people who want to, you know, do home improvements. I mean, how many times have you said to somebody, hey, do you have a home equity? Like when people retire, I always ask, do you have a home equity line of credit?
Oh yeah.
And you know, because hey, I own my house and I want to retire next year. I'm like, the first thing that you need to get is get a home equity line of credit. But I don't need it. I'm like, you don't need it today,
Right.
But you might need it down the road.
And you're not going to get it when you don't have any income.
Well, it'll be
harder.
much more
Be harder.
difficult to
That's
get.
right.
It'll be a little trickier. But right now, if you're making, you know, $150,000 a year and you own your house, guess what? The bank is going to see that and they're going to say, there's not a big risk there. There's
Right.
not a big risk
Right.
in us and giving you that home equity line of credit. So it's a plug for the local bank, for the local and regional banks. Again, do your due diligence. Make sure that they are kind of, you know, on the level. And I'm not going to speak on behalf of any of, you know, one versus another, but at the same time, the concept of the local regional bank,
Right.
I'm not afraid of those guys. I'm not afraid of that, so long as they have, you know, their ducks in order.
Well, and you know, the mortgage guys, like the brokers, are kind of in the same boat in the sense that these guys can talk you through what your options are just in general. You know, we talked about programs. You know, these, depending on what you're trying to do, these guys can talk to you and say, hey, this is how this loan, this is how this deal would be structured, right? And the reason that's a real thing is because I'm sure you guys see this on the financial side, but there's a lot of people that come to you, I'm sure from the wholesalers, that want to talk about different products, different investment opportunities, and a lot of those investment opportunities involve a substantial explanation of how this deal is financed, right? And you know, where everybody is in the, if it all falls apart, who gets paid with what money when, and how people get out. And the banks are putting these deals together. You want to, you know, you want to take advantage, unfortunately, of a huge correction in the real estate market in 2008, and you want to go out and you want to buy up all these unfinished properties in Arizona, for example, and companies did this.
Somebody did.
Right? But they had to come in with money.
Yeah.
They had to go to a bank and say, we need $300 million because we're building a portfolio of real estate and we need to get that money. Now, a small regional bank might say, that's a little bit too big for our flavor, right? It's not really in our wheelhouse. But you know what? Let me introduce you to my slightly larger, better capitalized cousin over here.
This is the Bank of Arizona versus the Bank of America.
That's right. And they can potentially handle this deal, right? And at that level, you know, they're going to get $300 million to go out and buy all these properties. They're not going to get 300 loans. They're going to get one gigantic loan, and then they're going to go out and they're going to start scooping up properties. Because why? Because that's their business proposition. And then they have to say, look, rates are really low. We picked up all this property on the cheap. The property's going to accelerate. We're going to pay off these loans. We're going to pay, and then we're going to have this huge cash flow machine that's just pumping out revenue to us. But that discussion starts with, well, where does the financing to put this deal together come from? Does somebody come in, big white knight investor, and say, I'll write the $300 million check? Maybe.
Sometimes
Maybe.
it is, right?
Sometimes it does happen that way. But that person also is saying, why would I put my money in the deal when I can use the bank's money?
Exactly.
Right? You know?
Yeah. Why do I take that risk, right?
Right. Well, because we joke about this all the time, right? Because if you owe the bank $500,000, that's your problem.
Yeah.
If you owe the bank $500 million, that's their problem,
Yeah.
right? And so now it becomes a whole, these conversations go on all the time about how am I going to use my banking relationship.
Yeah, and the whole thing is this is what, again, we going back to our original statement. This is how banks make money, right?
Yeah.
The bank assumes risk, and just like anything else, just like when you're investing, just like if you're deciding, hey, we want to buy a house, we want to move to a new, and we feel like that, we live in this town and we want to move to this town, and we think that property in our value of our house in this town versus this town is going to go up and going to be more. You don't know that. It's
Right.
You're assuming some risk, right? So same thing when you invest. Like, well, when I invest, I'm going to buy these stocks in these 10 companies versus stocks in these 10 companies. I don't know if that, I don't know. So there's risk involved. Or I'm going to buy stock in one company and put all my money into this one company versus stock in these 15 companies and diversify, right? So what happens is the banks, if let's say they make that $300 million loan to X investor or to X real estate developer,
Sure,
right?
sure.
And they say, hey, we're going to give you this money. Guess what? It's going to cost you. Not only is it going to cost you because you're going to pay us an interest rate.
Right.
You're going to say, this is the cost of borrowing money because we need to make money on this. But there's also you're also going to verify. You're going to substantiate this loan because you're going to put up other collateral property against this loan to be able to. So worst case scenario, your fault, my fault, nobody's fault. This thing blows up. We need to be able to recoup some or all of this money back.
Right. And that happens, that conversation happens. That's on the commercial side of the ledger. That's different than you going in and just making a deposit and taking your money out and using your bank in the way that most people conventionally use their bank, right? Those are different conversations. They're usually broken apart. Those worlds sometimes don't mix, are not supposed to mix, and they stay separate. And there's a breakdown between those two so that they don't come together. They're just two different divisions. One's a little sexier than the other one, but that's how they operate.
But that's and that's it. So you're the bottom line, the fundamentals, the basics of bank, like the Cro-Magnon banking is bank. You give bank your money, right? They hold your money. They take your money. They loan it to somebody else.
They take said money.
Yeah.
Yep.
And they loan it to someone else. And someone else says, "I will pay you to borrow this money." And the bank says, "Okay." So the smart banks, the ones is they don't overextend. They don't loan money to just anybody. They don't give
That's right.
They don't give your money to just anybody. They don't.
They do really good underwriting.
They
You know when you go in and they make you fill all that paperwork out and they want to check your credentials and see that you really know what the heck you're talking about and that your idea makes sense and
Think
that
about the last time
you
you
have
got
a
a loan.
history of paying back your bills. That's what the bank does
Yeah.
to everybody. You want to borrow $300 million? We're going to make sure that you actually have, to John's point, the ability to pay back said $300 million. We want to get that money back. We're not just making willy-nilly, and then you're going in and you're saying, well, here's my money. You're paying me 2. Thanks. We're going to go loan it out of 4 or 5 or whatever we're loaning it out at. That's all it is. It's not a lot of moving parts to that part of it for you as the sort of end user retail banking client.
Right, and so the smart banks, the ones who are doing who are doing their due diligence and making sure that they are running their business well, is they say, okay, what's the worst case scenario here? Oh, the worst case scenario is if the interest rates go up,
Right.
and if the interest rates go up quickly. So if the interest rates go up quickly, and as opposed to using hope as a course of action, like, hey, we're making a lot of money. Hope the rates don't go up.
Hope we get paid back.
Hope, but if the interest rates go up, that means that when Tom gives me his money and says, here, bank, I'm going to give you my money, and oh, by the way, if you don't give me 4% return on my savings account, I'm going to give my money to this other bank, right? And so now I have to be able to pay Tom to make it worthwhile for him to give me to hold his money, and then I have to be able to turn around and be able to loan it to Jay, and Jay's going to pay a higher rate, and because the rates are high, I have to make sure that I've done my due diligence and I've done my underwriting to make sure that Jay has the cape, because there's always going to be some that can't for whatever reason. But the more underwriting and the more business savvy that I am as the bank, I'm going to be able to say, okay, I'm going to have less people foreclosing or not being able to pay back.
Well, on their
loan.
balance sheet, the bank should be able to look at it and say, they rate their loans, right?
Yep.
They say, look, this is the quality of our loan stack, right? And these people right in the middle, these are our bread and butter borrowers,
Yeah.
right? We check them out. They pay their bills on time. They don't never miss a payment. They're writing these checks. We don't even lose a wink of sleep at night, and that's 60% of our loan, whatever the loan, whatever the portfolio of loans looks like. And then there's people at the top, right, that are the risk. That's the risk that's built into their portfolio. And they say, those people, these guys in the middle are all paying 4% on their loans, right? That's what we're charging them, and we're not losing any sleep about that. That's almost easy money. And then we get people up at the top level, right? That's another smaller, whatever the percentage is, and those people are paying 8%. 7%, right? They have a little dicier credit history. They may, and that may not be for negative reasons. I mean, they maybe made some investments, things didn't work out, market went against them, timing meets opportunity.
Or it's a different type of loan. It's a more speculative, like the real estate investment, or it could be.
Think about the cannabis industry 5 years ago, right? You roll into a bank 5 years ago and you say, hey, look, I want to build a pot growing
Cannabis
facility,
farm,
right? And nobody knew how to you had some ideas. But depending on the bank, they didn't know how to value that. They didn't know how to kind of manage your cash flows and what the expectation was going to be.
And like you said, there was still ambiguity on the regulation and what the
Can
costs
I even
are gonna
make
be.
the loan? Is
Exactly,
it a violation of federal law? Can we even do this? So you know what? Jay? We see where you're coming from, but we can't give it to you at 4%.
Yeah.
There's just too many unknowns, too much uncertainty. We can give it to you at 8%. And then I go through my calculations and I say, yeah, it works at 8%. That's fine.
Yeah.
It works better at 4%. But it works at 8. I'll do 8. 8's fine. At some point it becomes a little bit unworkable. Maybe you kind of come up with more cash. You bring in other investors. But
you may because you're in the ground floor of the cannabis industry.
Right.
You may I'll pay 12% because I'm going to make a lot of money right now. Right.
That's right.
And again,
That's right.
it's all based on your business model.
That's right. And then there's some percentage of the loans that are just falling apart. They're just not performing. The operation has gone belly up. Somebody's in foreclosure, somebody's in bankruptcy filings, and they're hoping to get back, pennies on the dollar at best. They're doing a workout. They're trying to figure.
Well, there's always going to be that percentage. There's always going to be, for whatever, like I said, for whatever reason, there's going to be loans that fail.
Right.
There's going to be things that fail. Just like in your stock portfolio, there's always going to be companies that don't perform.
There's always something that's not working the way you want it to work. So that's what brings that whole thing together, and that's where these banks that run into problems. That's where this happens, right? They get
too overextended.
Those bread and butter people,
Yeah.
There's less of them, and there's more of the people flying by the seat of their pants, and that's where things get dicey. So, take it for what it's worth.
And that was the thing. Back in 2008, the bread and butter was based on what these banks were calling bread and butter. They weren't bread and butter at all.
No.
That's just it. They weren't people that were paying their loans on
and nobody
time.
was calling them out on it. Nobody was calling them out on it.
And that was the problem. And that's kind of what.
That's how it built up.
Yeah, and the Silicon Valley is, although a little bit different scenario. Not that they were like, look, they have all these kind of they made all these loans back 5 or 7 years ago when the rates were nice and low and everything looked great, and they were like, and now all of a sudden the rates are up and they can't make that, they can't equate it, they can't recover
and remember, and because people were selling those loans, you didn't care as long as you weren't holding the loan when the music stopped.
Exactly.
So all you were doing was just facilitating we made the loan, everybody get paid, we sold the loan, somebody owns it now.
Yeah.
Somebody has to deal with the outcome of this thing falling apart, and that's where it got messy.
Yeah.
That's where it got messy.
All right.
All right.
So
Wow.
I mean,
My head
I
hurts.
hope we've all learned
Wow.
something today. No,
Man.
this is a real show. That's all right.
God.
You want to talk about music next time? We'll talk about banking music.
Banking
Yeah.
music. We'll talk about the songs.
late Eddie money.
The songs that you hear when you're sitting in the bank waiting
There you go.
6 hours for somebody to come out to ask you.
Like Southern Cross.
Answer your question
Yeah.
about the debit card. All right, we'll talk about that.
All right, we'll see everybody next week on Money Law, My FM 101.3, Hollis and Cable Access. Tommy, we'll see you next week. See you next week.
Have a great weekend,
you
everybody.
Hey, and have a great trip.
I'll do my best.
Right. So as you're listening to this, Jay is recovering from his St. Patrick's Day in Key West.
My shenanigans.
You may have to
we'll
text
report
me.
back.
Text me.
We'll
All
report
right.
back. All right,
We'll
we'll see everybody.
next time.
Have a great week.